This is not your typical breakdown of a daily recap. In this episode, I'm actually going to be covering one of the questions that I got in the comments. Is there any chance we could get access to your Notion template? And I've been asked this a couple of times because I show you guys what I use to record my trading days and all the setups that I could have taken or did take in a system that I built where I am just studying price action over and over and over again, which is allowing me to get extremely comfortable with my model to the point where I'm able to consistently execute it and know exactly what time that is going to play out. So today I'm going to show you guys the process that I use to build this, help you understand it so that you can create your own and use this to build your own trade model as well. So the reason I'm making this video is because I got this question, like I said, consistently in the comment. Is there any chance we could get access to your Notion template? So if you guys ask me questions in the comments about videos that you want to see, I will cover it on the days that I'm not trading. I didn't trade today because it's Monday. We have no news driver. And if you traded today, you probably know that the conditions were not optimal. No driver. It's Monday. I'm just going to sit sidelined. So on the days that I'm not trading, I will fill in these days with a video from whatever you guys would like to see in the comment section. So let's get into it. Now, before I cover the optimal intraday swing model study system, or simply my daily price action log that I use to log all the days that I've backtested and all the days that are playing out right now in the present moment, I have to put some background information behind what am I tracking exactly? What am I trying to track? What am I trying to understand? What do I need to understand? What data do I need to collect? And that would be under the umbrella of stage 2 of the five stages of trader development. So stage 1 is actually covered in one of my other previous videos. If you go to the homepage on my YouTube channel, I have covered the daily process that I take on a day-to-day basis, although that video is starting to get outdated because that process is continuously updated. But today we will cover stage 2, and that is developing, as in you are developing your own trade model. Step 1 would be your market approach. So the first thing you have to understand before you are breaking down your trade model is a market approach and understanding, because your setups are going to come after you know how you approach the market and what your market understanding is. By this, I simply mean how you look at the market. What are the concepts that you trade? What is your read on the market? Literally, how do you read the market? What makes it make sense for you for the market to go higher or for the market to go lower? So market understanding is simply the logic behind the concepts that you trade that explains why the market goes up or down. And that logic is what's going to go into your playbook. Your playbook is built off of that logic. Now, before I go any further, I want to give the credit to where I got all these notes from, and that would be from this video right here. I'm telling you guys, if you watch this video and you study it thoroughly and you watch it multiple times over and you take notes on it multiple times over and you apply what he is telling you to do, you will see progress. Because the second I did this and the second I started applying everything that he said in this video, I instantly saw results. I settled in on one trading model. I started building a process, a system of doing the same thing day in and day out, and look at my results over time. I'll show you guys what my results looked like when I first started watching this video and what they look like now. So if we go to rebuild June 2025, June 2025 is when I watched this video. Let's go to our multiples so we can get an idea of what my P&L curve looked like when I first started watching this video and applying the things that he taught. I was kind of break even, right? To now finally breaking out of that cycle. So I'm telling you guys right here, right now, this is it. Do this, and I promise you, you will see results. So stage 2, like I said, first is going to be market approach and understanding. It's simply the logic behind the concepts that you trade. The reason why you think the market goes up or why it goes down. And that is what you're going to use to start developing your playbooks, because eventually you're going to discover anomalies. Anomalies meaning things that consistently repeat that become easy setups you're comfortable with because you've seen it repeat so many times. And I'll give you a brief overview of what I mean by that. If I pull up my best playbook, let's go to playbook. Let's go to bearish premium gap opening setup. If I show you guys this playbook, you're going to simply see that it's the same kind of move happening over and over and over again, and that is an anomaly. So if you notice in this example, we have a gap up opening. If you look at the solid black lines, this is where we settled yesterday. This is where we opened today at 9:30. We have a gap up opening. The market trades up, fails at the high of day, and reverses to work towards filling that gap. And then if we look at the following example, it's pretty much going to be the same thing. In this case, we have an intermediate term high formed in the overnight session, gap up opening, fills that gap. If we look at the following example, it's pretty much going to be the same thing. We have a gap up opening, fills the gap. So I'm just going to run through a few more of these. We have a gap up opening, fills the gap. So we have a gap up opening, fills the gap. So we have a gap up opening, fills the gap. You get a point. So once you understand how you read the market and the logic behind your concepts, you're going to start discovering things that repeat over and over and over again and that makes sense to you. So essentially you have to create a language of how you read price and what makes it make sense to you. For me, and in order to create that language, you have to have some sort of framework, something that you can frame the market moves around, that you can apply the logic behind. For me, that would be simply be the gap opening at 9:30. The logic behind these playbooks is framed, okay, we have a gap up opening. Now, what happens when the market fills that gap? Why does the market fill that gap? What is the logic behind why the market gaps up and then fills that gap? So it's a framework that allows me to build logic around it, and that creates a language as to how I read price and how I see the market. So I know that when we have a gap up opening and the market meets X, Y, and Z criteria, I know that we're likely to open, trade up, fail at the high of day, and then reverse and fill that gap. Now that is an anomaly, something that repeats, and it makes sense to me. It's simply the same move happening over and over and over again with the same narrative behind it and the same market criteria. So you start discovering your anomalies, you understand the logic behind your playbooks, and this is where you begin to build the framework behind it and the language as to why it makes sense. Why does that setup do what it did there? Why, in this case, does the market have a gap up opening and fill that gap? I have to understand, why does the market do that? And the why is going to come from the logics behind my playbook. So understand why behind the playbook, which comes from the logic behind your concepts. Like I just said, what makes the market weak in that moment to be sold or strong to be bought? What in price action tells you it's weak or strong to be bought? You have to do the work of figuring out the why behind the setup. So for me, like I said, I've created a language in a sense that allows me to understand why the market is weak in this moment and should be sold and is going to fill that gap opening. It's a process, start to finish, and it's the same thing each time that the market does present this playbook. So you find your anomaly, you frame the logic behind it. That logic develops a language that allows you to understand the move, understand the why behind the move, and now it is something that makes sense to you. Now it's something that's consistently repeating. So how I worked to understand that is going to be step number 3. You have to understand the playbook, right? So how do you truly understand that? How do you understand the logic behind it? You have to back test it, and you have to spend time with it to understand the logic behind that. Create rules around it. This is how you truly understand the playbook and truly understand the language behind it. It's going to make it make sense to you. And then eventually it becomes something that is extremely defined. 1, 2, 3, X, Y, Z. And it's something that you can just go in there and know, yep, my playbook's here today. This is how I'm trading today. And that's it. That's it. It really becomes that simple and that easy once you have done this work here. And I'm going to show you the database that I use to do this kind of work. But first I have to explain the process behind it, right? I can't just tell you this is the database and not tell you how to use it, not explain to you how to use it. So we come to that understanding by back testing it, spending time with it to understand the logic behind it, and creating rules. You have to back test to get comfortable. Over time, you know how to execute it, when it will work, and when it may not work. The goal would be you are comfortable with what's going to happen when that is present. And this is exactly how I feel with this playbook. If you guys saw the trade that I executed on Friday, I was so confident that this exact move was going to play out. And I'll show you guys, it's literally the same move. If we go to a 15-minute, this is a 15-minute, right? This is where we settled yesterday. We had a gap up opening. That's 9:30. I don't have the 9:30 open price annotated, but we have a gap up opening, and what do? We fill that gap. I was so comfortable with executing this playbook. I knew exactly what time it was going to happen if we look at my trade plan. I wanted to see it happen at 9:30, and guess what? It happened at 9:30, and I was able to sell it right then and there because I'm extremely comfortable with it, and I have a really high conviction in what is likely going to happen because I am comfortable with it because I've done the work of back testing that playbook. That's the only way you can get good at it. It's the only way you can truly understand it. And that's the only way you can go in there, know it's there, and then repeat that. The goal is repeatability. Can you do it again? Because if you don't have a trade model, if you don't know what you're doing, if you haven't defined what it is, your system, your process, your way of looking at the market, your way of understanding the market, then what you're doing is not repeatable. Meaning you could take a great trade, but do you know why that trade played out? Do you know the logic behind it? Do you know why it happened at the time it did? Do you know why it happened in relation to what the daily chart looks like? Do you know why it happened in relation to the economic calendar? Do you know all these things? Because if you don't, then it's not necessarily something you can repeat. The goal is to make it repeatable. And you make it repeatable by understanding it. And you understand it by backtesting it, spending time with it, and using the database that I'm going to show you. So you need to create rules. Rules would simply be the criteria, the trade setup / environment to get to the entry, the market criteria. In this case, for me, it would be a gap up or a gap down opening. The time window, the window within you're looking for it to form. The idea of time is extremely important. You have to know what time that move is likely to come and what time looking for that move is going to expire. Meaning, let's say I have, in this playbook specifically, I know that this is not going to happen after 10 o'clock. After 10 o'clock, the odds of this playing out in this fashion severely diminishes. So I know that I'm looking for this move in that first half hour market open. So you have to have a time window of when it's going to happen and when looking for that move expires, if that makes sense. And then entry criteria is simply what you need to see in price action. That's the logic behind the trade, the why behind it, what you need to see in price to confirm the trade. Now I'll go into the Notion database that I've created, and I'll start pointing out these points in the database. So I need to shorten this a bit so I could easily scroll between all the different properties that I have. So I'm going to add a filter. Let's just say, and the date. No, not the date. And the day is Tuesday. Still a lot. Wednesday. Okay, perfect. Okay. Now, what did I just mention to you? You need to have rules, correct? So that would simply be your criteria, your time window, and your entry criteria. Now, by criteria, what I mean by criteria is the trade setup / environment to get to the entry. So if we go to the actual work that I've done to define this playbook, when I'm creating my rules, right? Step 3, creating rules. Criteria, the trade setup / environment to get to the entry. Now, if we look at what that is, it's simply how the market is setting up in the overnight and pre-market session before 9:30. So just a few things that are common, few characteristics in price that the market shows that are similar between each one of these examples of this anomaly that I'm trying to make sense for me, right? You're trying to create a language that makes you understand that move. You have to understand the why behind it. The first step to understanding the why behind it is putting some sort of criteria behind it, meaning when the market sets up in this way, it typically delivers that anomaly, the move that you notice that tends to happen over and over and over again. So in this case, the market criteria here would be when the market has a gap up opening and then reverses and fills that gap. This is typically how it sets up. We have a gap up opening. There's a smooth edge in price left in the overnight and or pre-market session, and it opens at or near the high of day. And you could see the same thing occurring in all the examples that I would show you. If I were to go through all of them, it would match all three of those criteria. So one of the properties that I have listed is criteria. And it's all three of those, right? And you can see how all three of these examples have all three of those boxes checked. Because why? Because it's the same thing happening over and over again. It's an anomaly. And now I've created a language. I've put logic behind it to make it make sense for me. Now it makes it more recognizable and repeatable because now I know when the market has a gap up opening, we have smooth sell side edge in the overnight session, and we open at or near the high of day. I know it's likely to open, trade up, fail at the high of day, and then reverse and fill that gap, which would be your next step, your entry criteria. Now, what leads to that actual entry? What leads you to actually putting risk on? What confirms that that move is going to happen? And for this particular playbook, what the market does, it will push away from the premium gap opening, meaning it'll open and trade up away from the 9:30 open price, and then it'll make a new high day and fail. And you can see again that those two entry criteria are checked for all three examples. So you're just making it make sense to you. Why does this move happen? What typically repeats when this happens, right? So we have a rally above the 930 open price. It's going to purge buy side, which would be the pre-market high a day, and it's going to prove premium sensitivity at a point of interest. All three of these things are repeated in every single one of these examples. It does every single one of these three things. Now, when I have these three things in price, I know that price is confirming that this playbook is going to play out. So criteria, how the market is setting up to where you know that, okay, this playbook might actually play out today. There's a strong likelihood that this might play out today because we have this criteria present, X, Y, and Z. Then entry criteria is what the market actually does to confirm that idea is going to play out, which would be another X, Y, Z. And that's going to lead you to actually putting risk on. These two right here, absolutely essential. So this would be your first step in understanding the anomaly. The first step in creating the language behind that playbook that makes it make sense for you would be market criteria, how the market is setting up to provide that kind of to provide the anomaly. This is how the market is setting up. This is typically what it does. Then the second thing is going to be entry criteria, what the market actually does to prove that that playbook is going to play out. Then, once you have defined this and done the work of defining this right here, then that's when I would go ahead and get an idea of what is the narrative behind that move, meaning higher time frame narrative. And this is really, really, really putting the logic behind the playbook. Now, this is thinking about the logic behind your playbooks. Now, for me, the way that I've created a narrative behind these moves is I've noticed that around the daily time frame, it typically presents one of three narratives, and that would lead to this market criteria, and then eventually this entry confirmation intraday, right? So that is the logic behind the playbooks. This goes back into step number 2. Now, I would try to hit this point first because you're trying to understand, like, okay, I'm noticing that this similar move is repeating over and over and over again. Okay, now why is that happening? And that why is coming from what? The logic behind your playbooks, meaning why should the market even trade the other way in the first place? Why should it trade lower in the first place? Why is that move happening? Why does it repeat like that? What is going on the higher time frame that is making that move repeat over and over and over again? And then what does that come from? The logic behind your playbooks. So the three narratives that I've framed behind this particular playbook would be, number 1, this move typically unfolds when we have an overextension of the previous day range. The previous daily range created a large impulse swing and price sees no discount through the overnight pre-market session. It's traveled too far into premium for smart money to buy it, and once it's the right time at 9:30, the market will seek a discount. So if we have an overextension of the previous day range, meaning the market travels in a extremely high premium, and with the logic that I trade, with the concepts that I trade, I know that the market moves from premium to discount, discount to premium, because the market is driven by an algorithm. And it doesn't matter if you believe this or not, it's just simply the logic behind the playbooks that I trade, or the logic behind the concepts that I trade. That's what I meant. It's simply the logic behind the concepts that I trade. So that doesn't have to be true. It's just the logic behind it. So if the market moves too far into a premium, I'm anticipating it to seek a discount, because if the logic behind the concept that I trade states that the market moves from premium to discount, discount to premium because it's driven by an algorithm, then that makes it reasonable for me to anticipate the market to begin seeking a discount. It puts the logic behind it. So that's the narrative behind the move. It's why this move is happening. The logic behind it. The logic behind the move. Why is that move even happening in the first place? The second narrative that I framed, previous day reversal. So if I am bearish on the weekly/daily time frame, I am anticipating a drive above the previous daily high to fail to build the high week. And it also sets up well when the weekly/daily is in consolidation. So if we're thinking in terms of the weekly power of 3, if we are bearish initially, we want to see the market drive up, right? Drive up above the previous day high. Offer the opportunity for smart money shorts to load into the marketplace to accumulate buy stops, buy side liquidity, be the counterparty to willing buyers at a high price, they're selling to those buy orders, to those buy stops. When I'm bearish on the weekly and daily, anticipating the market to form a high of week, so I'm looking for a drive above the previous daily high to fail. The logic behind it. And then simply I rebalance at the previous day range. The previous daily range settles on its low and indicates respect of the PD array from the daily/weekly time frame, so I can be bearish anticipating another down day. So you have to make that move make sense. The narrative behind the playbook is simply making the move make sense. The why. It's the why behind it. So once you've created the criteria and the entry criteria, like, okay, I'm noticing this one move that tends to repeat. Now, why is this move even happening in the first place? That would be your higher time frame narrative. You're putting the logic behind it. You're slapping the logic behind it. And the logic simply comes from the logic behind the concepts that you trade. So if I'm trading algorithmic theory, everything here is going to be basically framed off of algorithmic theory and ICT concepts and whatnot. So why should price trade lower? Well, for this particular narrative right here, it's too far in a premium without seeing a discount, so it will seek to move to a discount. The market is efficient, so it'll seek to rebalance the opening range gap, which is inefficient when we have that gap up opening. And the market is efficient, so it'll efficiently pair buy and sell orders. So if the buy side is moved above, it'll seek sell side next. So why should the market even trade lower in the first place? Again, just the logic behind your playbooks. And then these are repeating narratives that I've identified that really puts the why behind why that entire move unfolded in the first place. Okay, put the logic behind it. Find something that is consistently repeating. Note the characteristics of that, which would be your criteria, right? Okay, I'm noticing that this is typically repeating. This is how the market typically sets up. When it delivers this kind of move, it does this, this, and this. And then this, and this would put me into that trade. Now, why is that even happening in the first place? That is your higher time frame narrative. That's the logic behind the playbooks. So step 2, step 3 complete. Step 1 is simply the anomaly, right? It's the move that repeats over and over and over again. In this case, when the market has a large gap up opening with smooth sell side overnight, it'll trade up at 9:30 and instantly fail at the high of day, then do a gap fill and makes a large swing lower. So that becomes your playbook. Like I said right from the beginning, you discover an anomaly. Start building the language behind it, which would be the criteria, the entry criteria, and the timing, of course. Don't forget the timing. What time does that move happen? And then, why? Why does it even happen in the first place? But the logic behind it, make it make sense to you. Make it make sense to you based on the logic behind the concepts that you trade. Very simple process. So going back to the database, that's pretty much, it took me a really long time to figure those things out. Once you can get those things down, get those things figured out, and don't make it complicated, okay? Just make it really broad and basic, just a baseline of, okay, the market does this, and this when this typically happens. Don't try to make it extremely specific. Kind of generalize it to fit to that kind of move, because it's not going to be the same exact move in the same exact way every single time. Although this is as close as I could get to a playbook that's like this, it's not going to be the exact same thing every single time. If you look at the beginning of the video, you saw one example that was slightly different, right? But I still put it on the umbrella under this playbook, the bearish premium gap opening playbook. You want to generalize it and not make it too extremely specific. Just simplify it, okay? Don't make it more complicated than it has to be. That's what I did in the beginning. I made that big mistake of that, trying to make market criteria and entry criteria extremely specific. If you make it extremely specific, you're going to note that you can only apply it to maybe 3 examples of that. But if you create a broad umbrella of, okay, all these moves can fit under this is one similar thing that's repeating, then that's when it becomes easier for you to really understand that playbook. Now, aside from that, I wanted to spend a lot of time on that narrative and criteria, because that's basically what's going to make the playbook in the first place. The next things that I'm going to record, and the order of these is kind of out of line right now because I'm moving things around based on what I'm testing and what I'm working on right now. The problem that I'm struggling with right now is stop management and my exits. If we go to my problem solving model, right, I'm trying to build the skill of stop management and build the skill of exits. So you can see that's why I have these properties moved to the front, which is execution right here. And I'll explain this right now. Execution is simply the PD array that I would have taken to get me into the trade. So in this case, it would be a change in the state of delivery or an order block. And if we go to the 1 minute, we can see that the change in the state of delivery would be the PD array that I'm executing on, right? So execution is simply the PD array that I'm using to get into the trade. And I can kind of run through these really quick because the rest of these aren't really complicated at all. The ones that really needed explaining would just be criteria, entry criteria, and narrative to give you guys an idea of how to develop those. Execution is really simple. If you know that the logic that if you know the concepts that you trade, you know what you're entering off of. For me, it's PD arrays because I trade ICT. So it's going to be a bearish order block, right? Execution would simply be changing the state of delivery. The point of invalidation, doing this work right here has really allowed me to understand where exactly am I placing a stop loss. Point of invalidation is simply where that trade idea is proved incorrect. Where is the stop loss going to be for that setup? And keep in mind that all these examples that I've collected in this database were tested in hindsight. Or I did some back testing and then I went back and collected all the data from the days that I already tested. But most of the work done here, probably 80% of it, is done in hindsight. Hindsight study has really allowed me to understand my playbook. Because I've done this process many times over, many times over. You can see that this is version 3, right? So how it started out was version 1. You can see how it's this database that I've built has developed and evolved over time to become more and more organized, and my playbooks have become more refined and more defined. You can see that right here there's a lot of different variables that kind of don't really make sense. And then over time, that has evolved into version 2, which if you look at the properties, they're not necessarily the same, but now I've just defined it even more, defined and refined it even more, and by defining it and refining it, I'm making things more simple and creating an umbrella for things to fit under. Now it's evolved into version 3, where it's extremely precise, and it's the same things over and over again. So point of invalidation is simply where the stop loss is going to go. In this case, the stop loss would be at the order block extreme, so I'm simply tagging that as what? Order block extreme. Narrative, I explained that to you guys. I need to track day of week because eventually you will realize that particular moves happened on particular days with the property next to that, a particular driver. So it's extremely important that you note if that day had an economic impact event. It's extremely important that you reference the economic calendar at all times because ultimately this is what's going to drive the market. This is the injection of volatility. The market's not going to move if there is nothing on that economic calendar. If you look at what happened today, we had a really slow day after the 9:30 open, and a big part of that was because we had nothing on the economic calendar. So you know how the market is likely to play out if you are extremely comfortable with the economic calendar and how the economic calendar is going to influence and drive price that week. We had Monday with no news drivers, so we had a really large move in the overnight session, which is typically what happens on Mondays with no news drivers. We see these wild moves in the overnight session, and then the New York session is typically ass, to say the least. So you have to get really comfortable with the economic calendar, and you can see that I have literally annotated every single event that is on that economic calendar from no news driver, and I'm particularly interested in knowing what days had no news driver before a high impact event, because if you notice from doing this work right here, referencing the economic calendar, days with no news driver before really high impact events like CPI, NFP, and FOMC, they tend to be ass. So now I can build setup selection around the economic calendar because I've done the work of simply tagging what driver there was for that day and then knowing how that day played out because I have it right here logged in my price action log. So build setup selection by referencing the economic calendar, and that's also mentioned in the stages of trader development. If we go back to the Miro board, setup selection. Economic calendar. The economic calendar plays a factor. Upcoming events affect the probability of the setup, which doesn't make you comfortable executing on it. Based on economic calendar and what's happened in the market recently, will determine when the setup is probable and when it is not. So you're going to build setup selection around the economic calendar. You'll grow comfortable missing out on setups because of these factors. Meaning, let's say I see that the market is presenting the criteria and the narrative for my bearish premium gap opening setup, but we have no news driver before FOMC. It's the day before FOMC and there's no news driver, but the market is checking all the boxes for it to present my bearish premium gap opening setup. Am I likely to participate that day? Am I likely to put a lot of risk on behind that setup on the day of with no news driver before FOMC? Even though it's checking all the boxes in my playbook? No. Why? Because we know that the day before FOMC with no news driver is typically lackluster, typically unfavorable. So you begin to develop setup selection around the economic calendar simply because you're tagging these days, and now you're bringing awareness to how the market trades around the economic calendar. I made a huge mistake probably in the first 1.5 years of my trading career, just literally not referencing the economic calendar at all. I was only taught to reference the economic calendar and actually know how it moves the market once I started studying ICT, because that's one of the first things that he teaches, because this is what drives the market. Market's not going to move if we have nothing on the calendar. Straight up. So again, this builds setup selection because now you know when the market is likely to move and when it's not, when conditions are likely to be favorable and when they're not likely to be favorable, when they're likely to be unfavorable. Moving on to the next would be point of interest, and that's simply where the reversal was framed. If we look at this example, we see that the POI is PDH, meaning previous day high. And if we go to the 50-minute time frame, we can see that in this case, the market ran above previous day high. This is previous daily high, and we had a reversal. Now, in this example, the POI is not extremely accurate. Like, it didn't happen exactly at PDH because it happened at the high of day. So I need to add a new point of interest and just call it high of day. But if we look at this example right here, point of interest is a 4-hour CIBI. Point of interest here is a daily CIBI. This is probably a good example. If we go to the 50-minute time frame, first let's look at the daily chart. Note these dashed lines, right? These dashed lines are that daily CIBI, that daily bearish fair value gap. Now, if we drop to the 50-minute, we can see that dashed line from the daily chart, and we can see that the reversal is happening right at that. So the point of interest, really simple, pretty much self-explanatory, where that reversal is happening. That's it. So I've covered point of interest, entry criteria, driver, day of week. Day of week is extremely important because you'll note that these setups tend to happen on particular days. For example, my previous day reversal narrative tends to happen early on in the week because that's when we're building the high or low of the week if we're bearish. Doesn't really happen on Thursday and Friday, although sometimes it does, but you're going to see that it leans more towards the earlier half of the week because we are building the high of that weekly candle if we are bearish. So playbook is simply what that playbook is, and the playbook, remember, is the anomaly. If we go back to stage 1, the optimal intraday swing model, or sorry, stages 1 through 5, and we go to, actually no, yeah, the optimal intraday swing model, and we go back to stage 1. You discovered an anomaly, and that becomes your playbook. That's where it all starts. You discovered an anomaly, and that is your playbook. Now put the logic behind it. Now put criteria behind it. Now put entry criteria behind it. I've already explained how to do that in the earlier part of this video. Playbook, self-explanatory. Daily objective is also self-explanatory. I want to note, what was the daily objective for the day? Meaning, what was the furthest objective that the market reached for in that session? What did the market specifically reach for in that session? And if you look at all the examples of my bearish premium gap opening setup, remove this filter right here, you will see that the daily objective is what? Asia low, 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 Asia low. And the examples that I have recorded previous daily low, those days also delivered Asia low. So for the most part, I know with a really high degree of confidence that if this playbook is present, I can target the Asia low because I've simply done the work of tagging what was the daily objective for that session. What did the market reach for in that session? In this case, it reached for the Asia low, right? And all these examples, pretty much I would say 90% of these examples, it reached for Asia low. So now I know that I am holding my runners. When I'm in short, I'm holding my runners for Asia low. I can have a high degree of conviction and confidence that the market's going to deliver Asia low simply by doing the work of tagging what was the daily objective for that session. What was the furthest extreme that the market delivered? What was the level that the market reached for in that session? This is also going to get you really good at draw on liquidity because now you know when this particular playbook is present. You know that the draw on liquidity is going to be Asia low. And I've implemented this into my pre-market process. For example, this is the daily journal, right? My daily objective, it's the same thing as draw on liquidity, okay? When I say daily objective, I mean draw on liquidity. What did the market reach for in that session? What did the market reach for in that day? Now you can go into the market comfortable. Okay, this is my playbook. It's present. I can see it. The market criteria is there. The narrative is there. Now I just need to wait for the entry criteria to be there to confirm it. And I know that if it is confirmed, I know I can target these levels with confidence simply by marking what was the draw for that day. So extremely important. Daily objective can also be noted as draw on liquidity. Same thing. Same thing. Execution already covered. Point of invalidation already covered. Narrative covered. Day covered. So these are just all the properties that I am covering, right? This is a full breakdown of my database, all the things that I cover. I'm going to filter this back down so we can focus on what matters. Timing, extremely important. Notice how it's literally the second column to the right of date. Date is obviously going to be important. You want to track what date that it was. You can reference back in time and go study it if you need to with your backtesting software. But you'll also start to get a sense of confidence in your playbook because you'll see that this same setup happened 3 years ago and it's still happening to this very date. That's a good feeling. That's a good feeling. And you have a sense of confidence that this is just going to keep happening, and you should not feel any fear of ever missing out on the move because you know it's going to come again, because this is something that you have made sense to you because you've created a language around it, and now it's something that you can repeat. Now it's something that you can consistently execute. So timing is going to be number 2. You have to understand when this move is likely to occur, because if you look at the timing of this move, you can see that for the most part, timing occurs in that first 10 minutes of market open. We have 9:40, 9:33, 9:39, 9:30, 9:32, 9:30, 9:31, 9:33, right? So on and so forth. 9:30. So I know for the most part that if the market behaves a specific way after 9:30, now I know that the move is likely to come at 9:30. So if we go to the timing portion of rules, right? Now by doing the work of timing when that move was confirmed to me, and timing is simply when the move was confirmed to you. That's how I market. I don't market by when the market formed that high or low. I market by what time down to the 1 minute interval was that setup confirmed to me. Now I know that this move is going to come at 9:30 if price opens at the high day and immediately makes a new high day and fails. I know it's coming at 9:30 if price proves premium sensitivity at pre-market buy side or a fresh imbalance. So these are just examples of, okay, I've done the work of tagging the timing behind the move, when it made sense to me, when it was confirmed to me. Now, what made it confirmed in that moment for that move to happen right there at 9:30? It did this. It either did this, opened at the high day and immediately made a new high day and failed, or it did this, proved premium sensitivity at pre-market buy side or a fresh imbalance. If it does one of those two, I know it's coming at 9:30. So do the work of timing your playbook and then understanding, okay, this is what the market did at that particular time for it to be confirmed at that time. Now you know, into the future, if it does this, if it does X, Y, and Z, it's probably going to come at this time. If it doesn't do that, then it's probably going to come at this time. I know it's going to come at 9:45 between 10:30. If it opens off the high day or doesn't immediately fail at the high day and it takes time to deliver the point of interest. Now I have a time filter between when I can anticipate this move to happen based on how it trades after 9:30 and how it confirms the setup to me. This is extremely powerful, and this is the only reason why I was able to catch the move on Friday. Right here, I'm already on it, is because in my pre-market plan, I'm comfortable with this playbook, right? I have done the experience and the work behind understanding it through my backtesting system that I'm explaining to you right now. So I know that it's going to happen at 9:30 because we're opening at the high of day. So now the market is checking the box for this move to happen at 9:30. It's going to happen at 9:30 if price opens at the high day, immediately makes a new high day, and fails. But in this case, what did it do? It proved premium sensitivity at a fresh imbalance, rejected that and went lower. So I know we're going lower, so I'm selling it short right at 9:30. I know this move happens at 9:30, really early into the open. So I'm comfortable with selling it right into the open once I get confirmation. Let me narrow this back down. So date, timing, playbook, daily objective, execution, point of validation, narrative, day driver, all the properties that I'm recording. And then the last thing, this is at the end of the database, and that's simply going to be the trade metrics. Drawdown. Drawdown is going to be how much drawdown I incurred on that position before it was a winning trade. So if we go to the first example, we can see that the drawdown was what? 9.75 handles. So that means if this is my entry, if this is where I executed which is true because if we look at execution, it's the change in the state of delivery. If we look at the execution, that's where I executed, correct? Now, if I got an entry there short, how much drawdown did the market put me in before it played out? That would be 9.75 handles. The market went against me 9.75 handles before it moved in my favor. That's your drawdown metric. That's going to give you an idea of really how much you have to risk, because now I can go in here and I can play with the numbers, and I can do the same for every metric that I have here. And I have them on average right now just to get a baseline understanding of, okay, how much drawdown can I expect to incur on a winning setup? This is extremely important because you need to know how much you should be risking. I can go in here and I can go to the max. What was the most drawdown that I was put in before this was a winning trade in all examples that I've recorded of this playbook? What was the minimum amount? And then more importantly for me would probably be the average or the median, the midpoint. Okay, so now I know I should be risking, I should probably be comfortable risking, let's say 15 handles in this particular playbook, because the average drawdown that I experience before it becomes a winning trade is 11 handles. Next is full R. Full R is simply the risk to reward ratio and the best possible outcome. Now I will warn you, framing the best possible outcome is not how you backtest at all. This has created so many problems for me. Framing the best possible outcome is unreasonable because you're just trying to go in there and get your piece of the pie. You're not trying to do the absolute most. You're not demanding perfection from the market. You go in, you enter where you should, place a stop where you should, and get out where you should. Don't overstay your welcome. Don't ask for too much. Don't demand perfection, because asking for perfection is asking for frustration to become frustrated. So when you are doing this, don't use full R. I'll take this out right here. Do not frame the full R of the position. This is a solid do not, because you will condition yourself to demand perfection. If you condition yourself to demand perfection, you're going to breed mistakes into your trading, like framing stop losses that are too tight, or getting out way too late and never actually getting out, and then having the market come back on you and stop you out for break even, because you're trying to walk down the whole damn move and you're trying to demand perfection from the market. The whole month of September and even early August on the eval, I struggled with not being able to maximize my winning trades and having a lot of trades stop out prematurely, because I've done this right here, marking the full R on the position, which is basically I'm demanding perfection. Now, if I go into a live market environment, I'm not actually going to execute like that, am I? It's easy for me to sit here in hindsight and annotate the absolute best entry and the absolute best exit, but can you actually do that and apply it in a live market environment? Realistically, no, at least not in the beginning. Over time, sure, as you grow and become comfortable with your setup, which I am doing, and I had a really good exit on this position right here. I literally got out at the low of day. If you look at where I bought, and it never went down from there. But in the beginning, you should just be focused on recording your piece of the pie and being conservative, not trying to do the absolute most. So just frame the risk to reward on the setup, and you can simply do that by using the tool on TradingView. I'm sure I don't have to explain that to you. And then the risk is very self-explanatory, how much you would have risked on the position. The return is also extremely self-explanatory. What was the return on the position at your full objective, at the daily objective, at the draw on liquidity? How much would you have made had you got out there on an exit, on a take profit? And then duration, also extremely self-explanatory, how long you would have sat in that setup. So recording all these metrics, it's very easy, very simple. Let's go back to the top example. This is a good one. So with this tool, it's going to show you what you are risking. If you move your cursor over it, it'll highlight it and it'll show you the risk amount in points, and then the return amount in points as well. It'll also give you the risk to reward. So just use this tool on TradingView. If you trade, I know you know how to use this, so I don't have to explain it. And then the duration. If I'm targeting this level down here, then I'm going to measure how long it took from my entry to my exit. And that is the duration of the trade. Now, recording all these is extremely important because you have to get a baseline understanding of the metrics for your model. How much should you be risking? For example, on average, I'm risking almost 20 handles for this particular playbook, so I should not be scared to risk around 20 handles, right? We can see that the max is 21.75. So I know that I should be risking around 20 handles, but I know that I should be risking no more than, let's say, 25, because the max in all the examples that I have recorded is 21.75. So if I'm risking over 25 handles on a setup, that's an outlier. It's probably not an amount that I need to be risking at all. The only reason I know that is because I've done the work of recording this metric right here. That's it. Now you're going to do the same for return. For return, it's going to give you a realistic expectation of what you can get from that particular setup. You know, if your average return is 118 handles, well, you know you probably shouldn't be getting out at 20 because you're leaving a lot of money on the table, and you know you probably shouldn't be aiming for 300. So developing that baseline understanding of the metrics behind your model gives you an idea of what you should be aiming for, how much you should be risking, what you should be targeting. It's going to tell you all of that. And if you just average that number out, if you look at the maximum, the minimum, the median, you'll get a really good idea of what that is. You have to know your metrics, know your numbers behind your playbook, and be comfortable with that, grow comfortable with that. And then duration. Now you know how long you should be staying in this trade, how long you can expect it to deliver your full take profit. On average, right, it takes 82 minutes for the market to deliver the full take profit in this position. So I know this is not a scalp. This is more of kind of like an intraday swing. I'm holding for, on average, over an hour at a time. So I'm not going to expect to take this setup and be in and out in 10 minutes, am I? No, because that's not the way that I've designed it to be. The way I've designed it to be is holding for over an hour on average, right? So that's the last of the metrics. I believe I've covered everything now. And then if we just go to the way that I frame these and how I actually record these, I'm annotating everything top down. Weekly to 1 minute. I'm annotating everything that I possibly can. Everything that makes that trade make sense for me. I am putting the logic, I'm putting the why behind it, and I'm framing that setup from the weekly all the way down to the 1 minute. So I'm using these annotations, correct? Carrying them down from the weekly to the daily, to the 4 hour, to the 1 hour, to the 15, to the 5, to the 1. And notice how it's a microscope or a telescope, right? You start on the weekly time frame, you have a broad overview of price action. If you go down to the next time frame, the daily, you zoom in on it. If you go down to the 4 hour, you zoom in on it again. Go to the 1 hour, you zoom in on it again. And you get the idea, right? You can notice how with each slide, we're taking a closer look of what is going on behind those playbooks, or behind those time frames, behind those candlesticks. And as we move to each time frame, we are carrying the annotations down. Carry the logic from the higher time frame down to the lower time frame. Apply the logic of your concepts to the weekly, to the daily, and carry that down to the lower time frame, because your weekly and daily drives the lower time frame. Make sure you are trading in alignment with that daily time frame. And if you're not, then it better be reasonable for you to trade against it, which in this case I've developed a playbook that does make it reasonable for me to trade against it. But you're simply carrying that logic down. You're zooming in like a telescope or a microscope, however you want to see it. And each lower time frame slide is going to focus on a different segment of price, still carrying the logic from the higher time frame down to the lower time frame. Put everything on the chart that you need to put on there for the move to make sense to you. Put all the annotations necessary. And for the longest time, what I did, and I don't need to do this anymore because I'm comfortable with what I'm looking for and how I read the market and how I confirm trades. But if we go to Study System version 1, if we look at, God, these are ugly, and I used to annotate the charts in a completely different way, and this was not even 3 months ago, you know? So you can grow a lot in a short amount of time if you do these things correctly, but fill the spaces in with your thoughts, with your annotations of why that move makes sense to you. Fill in the gaps, and you can see that I did the same in Optimal Intraday Study System. Let's just fucking delete this. Version 2. I'm filling in the gaps with these thought bubbles, and I even created a system. Each color of these thought bubbles, these chat bubbles, whatever you want to call it, means a different thing. So in the light blue, if I'm annotating something in light blue, it's a light blue chat bubble, that means I'm annotating the draw on liquidity. If it's in yellow, that means it's the market criteria. If it's this light pink red and it's this rectangular box, that's the timing of the move. And I'm doing this, applying it daily down to lower time frame. So in the beginning, this is absolutely what you should be doing. You should absolutely be filling in the gaps with your thoughts on what is going on. Now, I've grown to the point where I don't necessarily have to do that anymore, and it has allowed me to collect more examples faster, but you absolutely have to do that in the beginning to really, really make the market make sense to you. And now for me, it's just annotations, nothing on the chart, no thoughts on the chart, but do start with your thoughts on the chart. You have to do that. I did that for the longest time. I could pull up an example from last August, my trade log from last August, and I have things from, this is August 19th, 2024. You want to see what my annotations look like? Still putting my words on the chart. And look how fucking ugly these charts are. Can you believe this? This is over a year ago now. This is crazy. But this is how you learn how to read price. Record it, put your thoughts behind it, make it make sense, and it's fun. It becomes a process. It becomes something that you enjoy doing. So now at this point, this video is almost an hour long, and I think I've given as much as I possibly can. Now, I may leave this template in the description of this video because that's what you guys asked for. But I'm not going to leave it with my content and my information. I'll put a bare bones link in the description if enough people ask for it. If enough people want it, then I will. And you guys can follow that. But I'm not giving you all the work that I've done. You have to go in there and do the work yourself, and you have to create a language for this to make sense to you for yourself. Okay? You're not just going to sit here and fucking copy me and not want to do all the work. If that's how you're thinking, then stop trading immediately, because you're not cut out for this shit. Because it's going to take a lot of work, a lot of sacrifice, a lot of grind, a lot of pain, a lot of blood, sweat, and tears. And I'm not going to sit here and hand you my work and have you copy it. No, you need to do this shit on your own. So that's going to be it for this one. I believe I touched everything. I gave a full breakdown. I can't even talk now. I've been talking for so long. I gave a full breakdown of my database and what I am collecting on a day-to-day basis. And I will go ahead and do that for today's trading session as well. Log it, put it in the price action log. And this has evolved over time. This is literally like 6 months of developing price action logs. I've built so many, but I started I actually started last August, right? So it's been over a year since I started building price action logs, but it's extremely important that you document your process and just keep your process, right? I have everything that I've worked on in the past, like it's all here. I can go back and look at everything that I've done in the past, everything that I've worked on in the past, and it's extremely motivating to go back and see how far you've come over time if you do track these things. I mean, look at all the work that I've done over time. It's pretty crazy to get me to where I'm at today. So follow the steps that I mentioned in this video, and look, it's not for me. It's from a motherfucker who's made 8 figures in the market. Some of you motherfuckers are going to be like, oh, he hasn't made money yet. I'm not going to listen to him. Motherfucker, I'm going to be rich as fuck off of this shit. And you know I am by the way that I talk and the way that I'm explaining this process. Come on. I know you do. I know you do. I know I am, and you know I am. But I'm just doing the things that successful traders tell you to do. They've already done it. They've given you a blueprint. They're saying, okay, look, you want to be a successful trader? I'm a successful trader, so you shut the fuck up and you listen to me. Do this. Okay, do it. It's that easy. The blueprint is there. Follow it. Stop being arrogant. Stop being ignorant. Get off your high horse. Kill the fucking ego and listen to somebody who's already done what you want to do. That's it. And most importantly, stop being a lazy motherfucker. Get to it.